those assets over time to be much more than if they were to do it net of taxes. Does that make sense?
Yes, and I guess my last question, because I don't want to hijack the entire meeting. So I'm curious, who is a typical third party? Is it like an individual buyer or is it like institution? Who am I
Buying,
selling my
I'll jump in
property
there,
to?
but buying your property would be just a regular buyer, whoever the buyer is, right? So, I mean, who's buying single family houses or rentals in Austin, Texas? A lot of people are, right? And
Yeah.
so for that scenario, it's just a regular buyer. That those aren't hard to find, and that doesn't really matter. It doesn't affect the buyer whatsoever. So we just find a buyer who's ready to go. But I did want to catch on this point because I think this is one of the biggest misconceptions of the deferred sales trust, and it's something you said, Sophie, is, oh, I thought I just get the $1,000,000 and all I ever get is the $1,000,000 in my return, or even so, I didn't even know about the return. That is an option. You can be a DST passive and just receive $1,000,000 at 8%, and just be passive and be like, okay, what does that mean? But it's up. By the way, it's compounding, okay, and it's typically a 10-year note. And hypothetically, if you took none of this 8% as a payment, you let it compound in 9 years, the rule of 72 kicks in, and that 1,000,000 will become 2,000,000. Okay, and then at that point you cash out. Although we do recommend taking payments earlier than that, but I just want to let you know like what it actually is if you're just passive, and that's just being a lender. And if this $1,000,000, not that it would go to $5,000,000, okay? Let's say we hit the lottery here, but that's also why Jake is a third party financial advisor. Not that it would. You're only entitled to this too if you didn't purchase an option on the upside, which you can. However, that's not really that realistic in the sense that most of our clients are simply, putting it diversified investment grade securities, maybe some passive real estate deals, and they're getting that 8%. And they're passive, and that's fine. But you can also become active. Okay, and remember what I said: lendership, meaning you can become an owner again of a brand new LLC, and the DST is $1,000,000 in here at 8%, can become a silent joint venture partner, JV partner with you, where you are an 80% owner of this LLC, and the trust becomes a 20% owner, but the trust puts up all of the money. In this scenario, it can put up to $800,000. We got to keep some liquidity. But this is the cool part, right? Watch this. Let's imagine you went and bought another 3 properties in Austin for $200,000. 3 houses at $200,000. And the same thing happened. But you waited for these markets to make sense. So you did this probably in a couple of years, or when people got foreclosed on because they overpaid. And you 246, actually you bought one. You actually bought 4. Look at that. What a deal. We'll give you one more there. 800,000. Now each of these properties goes to keep it simple, goes to 500,000. Okay. What's really cool about the deferred sales trust, remember you're an 80% owner. Let me also add, the trust is going to ask for an 8% pref, which all that means is it's 8% on the 800,000. Think of it like a loan, but it's not technically a loan because if it was a loan, it'd be taxable. But we're going to take this and we're going to grow. And these are all, about $300,000 gains. And this is where the upside is much greater than just this original 8%, because there's extra money left over, of which goes back into the LLC. And after the 8% pref is paid back to the trust on the original 800,000, the leftover goes 80% in this scenario to Sophie, our note holder. Okay. You following that, Sophie? I know that's a lot. This is why I'm writing it out. But the biggest misconception is, or one of them is, oh, I'm just giving it up and I'm just completely passive. No, you can be entrepreneurial. You can do this at optimal timing. You can do it when the deals make sense, and you can get the majority of the upside if we structure it the correct way. Does that make sense, Sophie?
Yeah, because that to me sounds like a bit more, for lack of better words, like a bit more sophisticated 1031 exchange, which I can actually pick, basically like do the transactions on my own timeline.
Exactly. You nailed it. It's at optimal timing, right? And that's the key, because the 1031 is not your friend when it comes to, buying back and out of real estate. The 1031, you typically are buying, you're selling high, and this marker's selling high, and you're buying higher 180 days later. So our parents taught us to sell high and buy low, right? That's the key. In fact, one of the best deals ever was done by a gentleman in 2006. He sold a property for $20 million in Minnesota, put it all into the Deferred Sales Trust. 5 years later, that bank calls him back and says, we just foreclosed on the property. Would you like to buy it back at 60 cents on the dollar? He says, yeah, give me a couple days. He reallocated the funds that were in the stock market, put it into an LLC, and bought it back at 60 cents on the dollar. So this is exactly what you can do. This is the key. At optimal timing. At optimal timing. So
Yeah, and it's only when I take money out of the DST, that's when I pay tax.
correct. You're only going to pay tax as you receive funds back. Right.
Okay.
Now we do need to start that within typically 2 to 3 years. We're starting a payment out to you. It doesn't have to be the full amount. It could be a partial interest payment. And that scenario will be, taxes, ordinary income, 1099. So yeah, that's exactly right.
And so the capital gain doesn't necessarily have to come from real estate. Say if I sell my stocks, I have capital gain that can also be part of the 1 million.
Yeah, exactly. It works for stocks, public or private. It works for, it needs to be a big enough deals though. They need to be larger deals, especially for the public stocks. Okay. Cryptocurrency. Jake and I just did a $5 million exit for a cryptocurrency client at when it hit 54,000 a coin. She's glad she got out at 54,000 a coin. Although she has another 45 million that has gone down quite a bit, but we're working our way back up. So it works for cryptocurrency, businesses, primary homes, investment real estate, LP interest, carried interest, captive insurance, partnership separations, just about anything you could think of. It just needs to be big enough to offset the fees.
Oh, I'm thinking about, can I take a kind of a hybrid approach in terms of in that 1 million, half comes from capital gain from real estate and half comes from the stock sales.
Yeah.
Okay.
Now here's the key. Let me also clarify. When you think stock sales, like you might have a mutual fund of 500,000 worth of 20 stocks. It's not going to be good. It needs to really be a single public stock. I think you're thinking about that, right? If it's lots of small, 100,000 here, 200,000 here, but if it's like a single stock where it's large enough, then yes. But if it's just like a mixture of 100 stocks, then no, because of the transaction cost, the complexity. It's not that we couldn't do it; it's that the cost it's not going to make sense because there's minimum transaction fees for every transaction, and it starts to add up, and so it needs to be big enough public stock. So, do you have public stock that's appreciated over $1 million?
Okay, got it.
Yeah. Okay. Got it.
Awesome. Thank you.
You're welcome.
I'll shut up now.
No, he's good. No, these are great. Everyone's learning. I know they're appreciating it. So we have Shane. We have Dr. Mumbasser. We have Nicola. We have anybody else that wants to jump in and say hello, ask any questions.
Peekins, who's also a commercial realtor out in New Jersey.
Peekins.
Yes. Hi everyone.
Hey, how's it going?
Doing good. Glad to be here.
Absolutely. Welcome.
And the nice thing about a lot of Sophie's questions, honestly, there's probably other people here watching right now that have similar questions that she was able to answer, or at least get answers to for everyone. So don't ever feel like you're asking too many questions, because Sophie, if you don't ask them, somebody else is going to. We just don't know when, right?
Hey, Brett, I have a question. In Sophie's example, you talked about hitting the lotto, her million maybe going to 5 million. Since Jake did such a good job of investing. I think you said something about Sophie purchasing a option for the upside in that growth. Can you maybe go more into that?
Absolutely. Hey, let me cover that. And so, in fact, Jake, why don't you cover that as I'm pulling up my iPad to share my screen?
Absolutely. So let's consider an options contract, like one that you can actually purchase in marketable securities, and then we can relate it to this type of possible transaction. Okay. So if we buy a call option, that is the right to buy a security at a certain price. So let's say we buy a call option on Coca-Cola. And if Coca-Cola, let's say it's selling at 50, and we buy a call option at 54. So essentially we're going to lose money if it doesn't go up. When I say lose money, you pay a small little fee, like $1.50 for this option to have a guaranteed purchase price of Coca-Cola. When does that become beneficial? That becomes beneficial. So you have the option to buy Coca-Cola at, let's say, 54. It becomes beneficial should Coca-Cola go up to like 70 or 80 or 100. If Coca-Cola goes way up, you've purchased the right to actually have this guaranteed price from somebody else who already owns Coca-Cola to buy it at 54. And so then you exercise that option. Even though Coca-Cola has gone way up, you don't have to buy it at today's price. You can buy it at your guaranteed contractual option to purchase at 54. And that's an example of an option. Now there's also put options, and there's different types of options out there. Plus, not only can you buy options, but you can sell options. But in this scenario, in regards to the trust, why would you buy an option? For the same reason that I explained in regards to Coca-Cola, the stock of Coca-Cola. But should you have assets inside of your trust that just go gangbuster wild, and we do really, really well, and we like 5 times the investment in a year, something of that nature, based on your risk tolerance, based on the underlying investments, based on what you're doing, all of those scenarios, right? If 1 million goes to 5 million, that could otherwise be a taxable event for the trust. But we're going to work with you. We see that coming prior to selling out of the asset. We're going to pay a little bit of money to the attorneys. And this is going to be an option contract so that even though there's a huge upside, we're going to recognize a gain only on a minimal piece, like what I was mentioning before, from 50 to like 54. And that's what we can lock in to mitigate the tax ramification of a very, very, very large gain within the trust.
Yep. So, by the way, it needs to be upfront, and it needs to be, typically it's 1.5% for a 10-year term. And
or a 10-year option agreement, yes.
Yeah, 10-year term or option agreement. And OPTI option agreement, okay? And so just to be really, really, really clear, so let's say that Sophie did want to purchase this option, and she closes on the trust, and she's like, I think Jake potentially could take this thing to 5 million. My investments could go to 5 million, whatever. I want the ability as the creditor to carve out the upside from the trust, because what she's typically do is just at 8%, right? And that's over the 10-year term. And so we're saying that this is going to, this is like, I don't know what, let's say in 10 years, what was going to be due to her was 2 million. So instead there's an extra 3 million here, right? The original one she put in, and then at 8%, that would have accrued to about 8 of another million, which is 2. So there's an extra 3 million. So what could she do? Well, on this initial million up front, she can buy an option for $15,000. So it's a one-time fee, or not even a fee. It's actually a purchase, because she's purchasing the rights to the upside. Okay, she can only exercise it again one time, and so it's hypothetically it's 9 years. 4 months, and had she purchased that option in the beginning, and that's when the 5 million hit the amount, she goes, I want to hereby exercise the option, and this extra 3 million can flow back to her, the note holder. Okay, so that's one way. Now the odds of this happening with Jake's investment, and really not even that, with the note holder's risk tolerance It's not very likely this happens, but it could. You know, you get on Amazon or Google at a low price. You know.
Well,
So
I mean, with the big market swings now, it's probably more likely to happen by accident than by any intention. And I say that because typically we're managing things from like a corporate asset management standpoint, because we're waiting for that next real estate deal. So we're not being very aggressive in the market. We're mostly focused on making sure that we're able to pay on the promissory note, which oftentimes is between 5 and 9%, whatever's commercially reasonable.
Yep, and it's a one-time purchase, and it's a personal check from note holder. Okay, from note holder, not from DST. So that, do you want to separate that, right? Because most of the fees, all of the fees, typically are paid by the DST. The DST is not doing this. The note holder is purchasing an additional right to exercise an option from the DST. So just understand that's what it is. So no one gets caught off surprise, because some of these numbers are like, well, I saw 1.5%. Didn't I already pay that? No, you pay the DST pay that to the tax return to set it up. Those are different. So this is an additional fee. Okay. Now, in practicality, most people are actually using the option when they're doing the LLC thing, right? Where they're putting, you know, keep it simple, $1 million went into the trust, 800,000 goes into this LLC. It buys a $1.6 million property, and said property goes to $3 million over 2 years. Okay, and they purchased the option on this 800,000, and then you got a loan, by the way. This was a loan for that other 800,000 there. Let's make this 1.8 so it's pretty simple here. You got a loan for $1 million. Okay, so what happens after that? Well, that $3 million has $1 million loan to pay off. Okay, so that's the debt, and then it's got to pay back the original $800,000, and this also was accruing at 8%. 8%, and a 2-year accrual, you would take $800,000. 8% is $64,000 each year, approximately. Okay. So that's $128,000. So that's the obligation back to the silent joint venture partner, which is the trust. So minus another $128,000. So back to DST. Okay, and this $800,000 was also back to DST. And so you got, so let's do the math here. We got 3 million minus the 1 million minus the 800,000 minus the 128,000, and that equals about $1,072,000. 1072. Now remember, in this original one I said it was an 80-20 split. So 80 to the note holder. But remember, the note holder put $0 into this LLC. They did actually all of the sweat equity. Whereas the DST put up all of the capital, but was a silent JV partner. Okay? So what's happening is, this is the net profit, 80% after the partnership operating agreement has been paid back, 20% to the DST. Now this is without an option purchase, okay? But in that scenario, we've got $857,000, $600 going to the note holder. Okay, why? Because they were 80% owner. Now you say, well, did they pay tax on that? Well, they could also roll that in back into the DST. The same DST as promissory note number 2. And then that would be at 857, 600 at 8%. Okay. Now this other 20%, you're like, well, what happens to that? Well, good question. This is 214,400. This goes all the way back to the original promissory note, which we're traveling way up here, which was right here, right? Which is at 8% compounding. And to the extent, and I don't know if someone can mute that person who's ever talking, that'd be great. And to the extent that this is not paid back, this 8% compounding, this 214,000 gets put back into this original million to pay back the note holder, right? So now, if they had purchased the option, they could have carved out up to 90% of this 20%. Okay? And that's really the key if you wanted to get, extra upside, which in that scenario, the DST would go down to 2% of this profit. And then the rest of it would go to the note holder. So I know that's a lot there, but Ryan, does that make sense there?
Yes, that makes sense. Thank you for clarification.
Very good, Brett. 3 questions before we go because we are out of time.
Yeah.
1 question, and these are going to be rapid fire. So, have an individual. Okay, maybe I'll make it more rapid fire. The client is married, recently married, has an asset from long before the marriage, lives in California with you. Well, not with you, but they're in California.
Taxifornia, yeah.
Yeah, Taxifornia. Client is all about making sure that spouse gets everything that they deserve, but doesn't really want spouse involved in all of the transactions that they might incur within the trust. How does that work based on the household status of these trusts?
So make sure I understand it. So are they married?
Married now, recently married.
Okay, recently married. Got it. And yet one of the spouses doesn't want the other spouse to do what?
So this very well-to-do lady just married a very nice fellow and wants to make sure that, she's comparing it to her family trust where spouse is going to be beneficiary. And, the truth of it is this is a little different because this is a business trust, more closely related to like an irrevocable trust, where in the beginning, just to have the trust, both spouses should sign. So she would like to just maintain control, not necessarily give visual access to the spouse and all these other things. So help me understand the best way to explain from the trustee perspective, the involvement of the 2 spouses. Spouse A, the lady, she is very entrepreneurial and she's going to be selling lots of stuff that's going to go into the trust in the future.
Yeah, so I think that's more of like either a prenup and or like an estate planning attorney to keep it separate if that's what they're trying to do, which we don't practice that. If they have that, I think they would get with the DST tax attorney and us to see how we can try to mirror this up. But really, I think a couple clarifying questions. Like if she were to pass, where does she want the income of the trust to go to the spouse or not? And then, and if not, then what's a way to present or structure the promissory note where it's only in one person's name? So we'll have it. So really the answer is it all depends. And you've given me some facts there, but I would like the tax attorney who created the whole thing to go through it and really dissect those particulars, Jake.
All right, very good. Well, we'll have to get that on the calendar so that we can go over that because that literally hit me like 10 minutes before our meeting. So kind of fun, kind of exciting. And again, here what we do is we try to find answers to people's questions and make sure that we can provide a solution based on the desired outcome.
Absolutely. Jake, if people want to find you, where can they find you?
strategictaxsolutions.com and 1-800-773-1848. Again, that website is strategictaxsolutions.com.
Hey, we want to thank everyone for joining us today. I want you to check out our new book that's coming out, the Capital Gains Tax Solutions book, Building a Tax-Deferred Exit Strategy. And it's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. You can go to capitalgainstaxsolutions.com, look for that. The Jake Miller will be in the book, and I'll be in the book. You have people like Kevin Harrington from Shark Tank in the book too. Pretty cool stuff. And I want to invite you to bring someone back next week. I want to continue to encourage you to keep diving in to the content of the Deferred Sales Trust and everything we're doing here at Capital Gains Tax Solutions. Please rate, review, subscribe to the YouTube channel, our podcast, and we will talk to everybody real soon. Thank you so much and have a great rest of your day.